Please like, share, and subscribe. Wishing you happiness and good luck every day.
So, what happens when a mathematician, an expert in logic, in numbers, tries to beat the stock market? Well, today we're diving right into that exact question, using a fantastic story from John Allen Paulos' book, A Mathematician Plays the Stock Market. I mean, it's the perfect setup, right? You have this brilliant mind, someone trained in pure logic and probability, and he steps into the wild, chaotic, emotional world of the stock market. You'd think, okay, this guy's got it made. He's got an edge. Well, that's the big question we're going to unpack. And this quote, it tells you everything you need to know right up front. This isn't going to be some dry academic exercise. Oh no, this is a deeply personal story about how things went spectacularly, painfully wrong. It's a real cautionary tale, straight from the man who lived it. So, where did it all begin? Well, like so many of these investing stories, it started with what felt like a pretty small, almost harmless bet. Okay, picture this. It's the year 2000. The dot-com boom is absolutely raging. Paulos gets his hands on some unexpected cash, what he calls his mad money. And he decides, you know what? I'm jumping in. He buys shares of WorldCom, which at the time was this unstoppable tech titan, a cornerstone of the internet. And everyone was telling him it was a strong buy. And this, folks, is where our mathematician starts to realize, wait a minute, the market isn't a math problem. It's really more of a psychology experiment, and there's this perfect concept for it from the famous economist John Maynard Keynes. Keynes had this brilliant analogy. He compared investing to a newspaper beauty contest from back in the day. Now, the goal isn't to pick the face that you personally find the most attractive. Nope. To win, you have to pick the face that you think the majority of other people are going to choose. See how that completely changes the game? You're not valuing the thing itself anymore. You're valuing what you think other people think about it. And this is where your brain just starts to spin, right? Because it's not just one level deep. You have to guess what other people are thinking. But then you have to guess what they think other people are thinking. And then you have to guess what they think other people are thinking about what you're thinking. It becomes this insane, infinite loop of second-guessing the entire crowd. So here's the big takeaway from all that. Paulos realized that trying to figure out the collective mind of the market, the psychology of all the other players, was a totally different skill from just analyzing a company's finances. And let me tell you, it's a much, much harder game to play. So if figuring out the crowd is so ridiculously hard, what makes it so difficult? Well, it turns out the problem actually starts right here, in our own heads. We have these built-in glitches in our thinking. And as Paulos found out the hard way, not even a mathematician's brain is safe from these really costly biases. Okay, so this is really the heart of the story. The WorldCom stock starts to slide. It drops from $47 down to $30. So what does Paulos do? Instead of cutting his losses, he buys more. It's a moment so many investors can relate to. Why? Why on earth do we double down on a losing bet? Well, the answer is all about how our brains are wired. He fell into this classic trap. On one side, you've got this very hopeful logic of averaging down. You tell yourself, hey, I'm just getting it at a discount. This is a bargain. But on the other side, there's the grim, painful reality of catching a falling knife. How in the world do you know which one you're doing? That line between a smart move and a complete disaster is just razor thin. So what exactly was going on in his brain? Well, let's look at the culprits. First, the anchoring effect. His mind was stuck on that first price, that $47, making everything below it seem like a great deal. Then you have confirmation bias. He started desperately searching for any little piece of good news about WorldCom to prove he was right and totally ignored all the warning signs. And maybe the most powerful one of all, loss aversion. The sheer pain of admitting he'd made a mistake was so strong that he was willing to risk even more money just to avoid facing that loss. So if his own brain was betraying him, maybe the answer wasn't to trust his gut, but to look for patterns in the crowd's behavior instead. This brings him straight into one of the biggest, oldest debates in all of finance. All right, so you've got two totally opposite camps here. Is the market a predictable wave you can ride, or is it just a bunch of random coin flips? On one side, you have technical analysts. They believe history repeats itself. They study charts and patterns, convinced that the crowd's momentum, the trend, can tell you where things are going. But on the other side, you have the random walk theorists, a view, a lot of mathematicians might lean towards, who say it's all just unpredictable noise. Any new information gets baked into the price instantly, so what happened yesterday is totally irrelevant for tomorrow. And these technical analysts, they have a whole language for this stuff.
They'll talk about a stock price hitting a support level, like a floor it won't drop below, or a resistance, ceiling it can't break through. They even see shapes in the charts with these wild names, like a head and shoulders, that they think are signals to buy or sell. It's really an attempt to find some kind of order and what a lot of other people just see as total random chaos.
So, after this whole roller coaster ride, from the mad money and the dot-com bubble to the cognitive biases and these huge market theories, what's the final lesson? What did our mathematician actually learn from his painful real-world experiment?
And this is it. The most profound lesson he learned didn't come from a formula or a stock chart. Turns out it was something his father had told him. The market isn't a puzzle that you can just solve. It's an environment of pure, fundamental uncertainty. And the only real strategy, the only real security you can have is to accept that and learn how to live with that insecurity. A really powerful lesson, not just for investing, but for, well, pretty much all of life. Have you ever stopped to think about what really drives the stock market? I mean, is it all just balance sheets, revenue growth, and shiny new products? Well, what if I told you it's often less about the numbers and more like a giant high-stakes game of guessing what everyone else is guessing? Yeah, that's the crazy puzzle we're going to unravel today.
Now this doesn't sound like it's from an investment report, does it? It's actually a confession from mathematician John Allen Paulos about a stock he bought. It's such a surprisingly emotional way to start a financial story, and it just perfectly captures how even the most logical minds can get swept away by a good story. So, what was the object of this disastrous affection?
That's right, WorldCom. Today, that name is, infamous. It's synonymous with one of the biggest corporate frauds in history. But back in the late 90s? Oh, it was the absolute darling of the tech boom. And this sets up a fascinating question. How could someone so rational fall so hard for a company that was basically a ticking time bomb?
Well, the thing is, the love affair wasn't totally irrational. I mean, look at this. On the surface, WorldCom looked like a slam dunk. You had all the experts, the gurus, singing its praises. It was a massive global player, pulling in huge revenues, serving millions of customers. On paper, WorldCom looked absolutely unstoppable. It was a story everybody wanted to believe in. And that belief? Well, that's the key to this whole thing.
This whole idea of belief brings us to a brilliant concept from the economist John Maynard Keynes. He said that if you really want to understand the market, you have to stop thinking about spreadsheets and start thinking about a beauty contest. Yeah, a beauty contest. Okay, so here's the core idea. In Keynes' game, you don't win by picking the face that you personally find the most attractive. No, you win by picking the face that you think most other people will choose. Your own opinion? It's totally irrelevant. What really matters is how well you can predict what the crowd is going to do.
And it gets even deeper. It's not just one level of guessing. You have to anticipate what the average person thinks the average person is going to think. It just spirals into this game of second guessing and third guessing. It becomes this wild psychological puzzle, not a simple math problem.
And this is really the big takeaway. The market often rewards the most popular stock, not necessarily the most fundamentally sound one. The price gets driven by what people believe other people believe. With WorldCom, it wasn't just about its revenues. It was about the shared belief that everyone else also saw it as this can't-miss opportunity. All right, so that's the theory. It's a little abstract, right? So let's make it way more concrete. We're going to play a game that perfectly shows how this layered thinking really works. Okay, think about it for a second. Choose a number between 0 and 100. The trick is, you win if your guess is closest to 80% of the average of everyone's guess. So what's your first instinct? What number just popped into your head? Go ahead and lock that in.
All right, let's break down the logic here. A simple first guess, what we'll call level 1 thinking, just assumes everyone else is guessing randomly. So the average would be about 50, right? So you guess 40, that's 80% of 50. But then you think, wait a second, other people are going to do that too. That's level 2 thinking. So you anticipate their guess of 40 and you choose 32. But what if they anticipate that? You see how this just keeps spiraling deeper and deeper until logically it leads all the way down to 0.
And here's the kicker. The purely logical mathematical answer is 0. But here's the thing. When you actually play this game with a real group of people, the winning number is never 0. It's usually somewhere between 20 and 35. Why? Because the winner isn't the most logical person in the room, it's the person who best predicts the average level of logic of the whole group. Being market right is all about psychology, not pure math.
So what does this silly number game have to do with billions of dollars on the stock market? Well, turns out pretty much everything.
It's more than just a thought experiment. It's a really powerful model for how markets actually behave. So the crucial point is this. When you're buying a stock, you're not just buying a piece of a company. You're actually making a bet on the future psychology of all the other investors out there. You have to try and gauge their fears, their optimism, their level of thinking, and that is an incredibly difficult thing to do.
Now, let's take this one step deeper into an even more fascinating concept. It's about this subtle but absolutely explosive difference between what we all know privately and what we all know that everyone else knows. This is the power of common knowledge.
Check out this distinction. Neutral knowledge is simple. Say everyone in a room knows it's raining outside. Easy enough. But common knowledge is way more powerful. That's when everyone knows it's raining and everyone knows that everyone else knows it's raining, and on into infinity. This tiny difference can be the trigger for sudden, coordinated action, like a market crash.
To really understand its power, let me tell you a famous story. Imagine a village where every wife knows about every other husband's infidelity, but she's blind to her own. Now, let's say there are 20 unfaithful husbands, but life just goes on because no wife has definitive proof about her own husband. Then one day, a trusted matriarch stands up and announces publicly, "There is at least one unfaithful husband here." Now think about it. This isn't actually new information. Every wife already knew that, but her public announcement makes it common knowledge. For 19 days, there's just silence. Then, on the 20th day, all 20 wives act at the exact same time. So why the long delay? Well, each wife was using the silence of the others as information. She was thinking, if my husband was the only unfaithful one, his wife would have known on day 1. If there were only 2, they would have acted on day 2. Those 19 days of silence proved to each of the 20 wives that her own husband had to be one of the culprits.
This is a perfect, if a bit dramatic, model for what happens in the market. The rumors about a company cooking its books, those are the secret infidelities. That official SEC investigation, that's the matriarch's announcement. It doesn't really introduce new facts, but it makes a suspicion common knowledge. And the result? A sudden, coordinated sell-off that seems to come out of absolutely nowhere, but was actually building up under the surface the entire time.
So the trigger for a market crash isn't always some brand new piece of information. It's the public signal that turns all that private suspicion into public panic. It's that moment when everyone realizes that everyone else knows the bad news too. And that is exactly when the rush for the exits begins. So, this leaves us with one final big question. In this incredibly complex game of anticipating what others are anticipating, where should you focus your energy? On the cold, hard financial statements of a company? Or on the wild, ever-shifting psychology of the crowd? You know, maybe the smartest move is realizing you can't ever really separate the two. So what happens when a mind that's, trained in pure logic gets tossed into the absolute chaos of the stock market? Well, today we're going to look at the story of a mathematician who found out the hard way that when money's on the line, our own brains can be our worst enemy. We're going to do a deep dive into the psychology of fear, greed, and all the little tricks our minds play on us that can cost us, well, everything. And this quote, this is a pretty raw confession. It comes directly from mathematician John Allen Paulos. I mean, think about it. Here's a guy who lives and breathes logic, right? And he's admitting his investment decisions weren't driven by data, but by something way more primal, just a gambling instinct and this deep-seated need to be right. All right, so how did it all go so spectacularly wrong for him? Well, the story starts with a company you might have heard of, a now infamous company called WorldCom. And it all begins with a classic mental trap that just completely warped his judgment from the get-go.
Okay, so WorldCom's stock price starts to fall. It drops to $30 a share. Now logic is screaming, sell, get out. But what does he do? The exact opposite. He buys more. This is a textbook case of what's called confirmation bias. He was actively looking for any piece of good news, any little scrap that would make him feel good about his decision, all while completely ignoring the blaring red flags. And, this decision, it wasn't just one bad call. It was really the first step down this incredibly dangerous psychological spiral. It's a place where the nice, comforting stories we tell ourselves just go head-to-head with cold, hard reality. So the story he was telling himself was, oh, I'm just averaging down. It's a very smart-sounding strategy, but the reality?
The reality was way uglier. He wasn't pulling off some clever financial move. No, he was trying to catch a falling knife. And as anyone who's tried knows, that's a really painful and frankly foolish game to play.
And here's the thing, it wasn't just his own brain playing tricks on him. The entire financial world seemed to be screaming buy. You had big-name analysts, all the brokerage firms, they were all on the same page. Now, deep down, he knew these ratings were often, let's say, a little over the top, kind of like movie reviews, but the sheer volume of all that positive noise, it was just impossible to ignore.
And this right here is the internal monologue of pure denial. This idea of a paper loss, it's probably one of the biggest lies investors tell themselves. It's this mental trick to pretend the loss isn't real, you know? But as he admits, right here, he says, "Did I really believe this? Of course not." But he acted like he did.
Okay, so this whole personal story is just a perfect illustration of these weird mental glitches, these cognitive illusions that are always running in the background. So let's actually break down some of these traps that our own minds set for us.
First up is something called the anchoring effect. And it's pretty simple, really. It's when the very first piece of information you get, usually a number, kind of gets stuck in your head. It becomes an anchor that drags all of your other judgments toward it, even if that first number was completely random. Let me show you how this works in the real world. So, in one study, they asked people a simple question. Is the population of Ukraine more or less than 200 million? Now, that's a huge number, right? And what happened? Their guesses all clustered way up high, right around 175 million.
But then, watch what happens. They asked another group the same question, but they changed the anchor to just 5 million. And boom, suddenly the average guess plummets down to around 10 million. Now, of course, the actual population of Ukraine didn't change one bit. But that anchor, it totally warped their perception of reality. And this is exactly what happened to our mathematician. He was anchored to WorldCom's old super high stock price, so every time it dropped, it just looked like an incredible bargain.
Now, this ties into another incredibly powerful force called loss aversion. And the idea is really simple, but also pretty profound. Basically, the pain you feel from losing $100 is way more intense than the good feeling you get from finding $100.
And this is where loss aversion really messes with our heads and makes us irrational. Just look at these two scenarios here. On the left, when the choice is framed as a gain, most people play it safe. They take the sure thing. But look at the right. Frame the exact same outcome as a loss, and suddenly people are willing to roll the dice. We become risk takers. We'll take a huge gamble just for the chance to avoid a guaranteed loss.
And trust me, the list of these mental traps just goes on and on. You've got the availability error, which is basically when we're swayed by the most dramatic example we can think of. Then there's the status quo bias. That's just our brain's lazy preference for keeping things exactly as they are. And oh, the endowment effect. That's the one where we overvalue something simply because we own it. You know, it's my stock and I love it.
And then there's this really weird one called mental accounts. This is our brain's bizarre habit of putting money into different imaginary buckets. And we treat the money in each bucket completely differently. There is no better way to explain this than with the story of the man in the green bathrobe. So get this. This guy goes to a casino, starts with a single $5 chip, and ends up winning and losing millions. When he gets home, his wife asks how he did, and his reply is, "Not too bad, I lost $5. See? In his head, all those millions were house money. It wasn't real. It was in a different mental account. The only real money he lost, in his completely twisted logic, was the $5 he started with.
Okay, but here's where it gets kind of scary. These internal biases, they're not just harmless little quirks. They are vulnerabilities. And there are people and systems out there that actively exploit them. Everything from anonymous people in online chat rooms all the way up to Wall Street itself. One of the most classic internet scams, one that just preys on pure greed, is the pump and dump. And here's how it works. It's a simple 3-step playbook. First, a small group buys up a ton of a cheap, unknown stock. Second, they pump it. They flood the internet with hype, with misleading news, whatever it takes. And then, once the price spikes from all the new buyers, they dump all of their shares, walk away with a huge profit, and leave everyone else holding worthless stock.
And you know, this scam has a dark side twin. For when markets are falling, it's called short and distort. So instead of buying and hyping, the scammers do the opposite. They short sell a stock, which is basically a bet that its price will go down. Then they distort the truth by spreading negative rumors and outright lies to create a panic. Once the price crashes, they buy the stock back cheap and pocket the difference.
So,
where do these scams really take root and grow? Online chat rooms. The author calls them rant rooms, which is honestly the perfect name for them. They just become these toxic echo chambers where fear and greed get turned up to 11. It creates this massive feedback loop that just amplifies every single cognitive bias we've been talking about.
So the big question is, how do we fight back? How do we defend ourselves against our own faulty thinking and these external predators? Well, the first and most crucial step is just awareness. It's not about finding some magic bullet. It's about learning to recognize that moment when your gut feeling, your intuition, might be leading you astray, and then having the courage to actually question it.
To see what I mean, just think about this chilling paradox from the DC sniper case back in 2002. So which of these two things do you think is more likely? A, that a totally innocent person would just happen to own a white van, rifles, and a sniper manual, or B, that a person who owned all of those specific items would in fact be innocent? Now, for most of us, our gut just screams that the answer is A.
And this is just a brilliant example of how flat out wrong our intuition can be. The correct answer is overwhelmingly B. And you might be thinking, how is that possible? Well, it comes down to simple math. There were millions of innocent people in that area, right? But maybe only, let's say, 10 people in total fit that very specific description. That means if you found someone who fit the profile, there was actually a 9 out of 10 chance they were innocent. Just being aware of these kinds of mental traps, it's really the only defense we have.
And that really brings us to a final, pretty provocative thought. It's inspired by a cartoon the author's father sent him once. You've got this guy just sitting happily on a park bench, and he sees this long line of serious, stressed-out businessmen marching past, and he just calls out to them, "Who's winning?" It's such a simple question, right? But in this incredibly complex game of money, psychology, and just life, are we ever really sure we know the answer?
So what if you could predict which way the stock market is going to go, just by looking at a chart? It sounds a little like magic, right? Well, that's the basic promise of something called technical analysis. And today, we're going to dive into this really controversial world, but we're going to do it through the eyes of a mathematician who learned a very, very expensive lesson. Sometimes you just can't bet against the crowd.
Our story kicks off with a total disaster. See, the author of our source material, he's a mathematician, and he owned stock in WorldCom right as it was completely collapsing. Now, he had this deep, almost academic distaste for what he called herd mentality. He just thought the panic was totally irrational and that the crowd was simply wrong.
And this quote, right here, this was his whole mindset. He was a rationalist, a guy who trusts hard numbers and company fundamentals, not the emotional whims of 1,000 strangers. For him, following the crowd felt like giving up, like abandoning reason itself. But oh boy, the market was about to teach him a very painful lesson.
Hubris. Wow, that's a powerful word. He came to realize that ignoring what the rest of the market was doing, no matter how illogical it seemed to him, well, that wasn't some noble philosophical stand. No, it was a financially devastating mistake. He learned the hard way that sometimes the crowd is the market.
Okay, so that painful lesson leads us to a really, really important question. If the crowd has this much power to move prices, what rules is it even following? What's the secret language that all these traders seem to be speaking when they're all staring at the same charts?
Well, that secret language is called technical analysis. It's this whole world built on the belief that you can figure out the market's next move just by studying the patterns on its charts without ever looking at a company's balance sheet.
At its very core, technical analysis, or as our source calls it, maybe more accurately, trend analysis. It's all about momentum. The central idea, the mantra you'll hear over and over, is super simple. The trend is your friend. Once a stock starts moving in one direction, it's probably going to keep going that way, for a while at least.
Now, to really get a feel for the whole spectrum of technical analysis, from the mainstream to the, well, out there, we've got to start at the deep end. We're talking about the part that feels less like finance and a whole lot more like numerology. So let's take a look at the strange and fascinating Elliott wave theory.
All right, this is where things start to get a little bit wild. We're about to explore this idea that the market isn't just a series of random events at all. Instead, it might be governed by some kind of hidden, almost mystical mathematical code.
So here's the theory in a nutshell. It claims the market moves in this predictable 5-3 rhythm. You get 5 waves moving up in the main trend, followed by 3 corrective waves moving down. And get this, the whole pattern is supposedly based on the famous Fibonacci sequence, and it's a fractal,
meaning you can supposedly see this same 5-3 pattern on a 1-minute chart, a daily chart, or even a 50-year chart.
Now the sequence itself is pretty simple, right? You just add the last two numbers to get the next one. But here's what gives it that mystical vibe. People see this sequence everywhere in nature. In the spirals of a pine cone, the petals on a flower, the chambers of a nautilus shell. It's kind of uncanny.
And it gets even weirder. If you take any number in that sequence and divide it by the one before it, the result gets closer and closer to 1.618, the golden ratio. This number, also called phi, has been revered for centuries. It shows up in art, in architecture, all praised for its divine perfection. The real leap of faith, of course, is believing that this same number also secretly controls financial markets. Okay, let's step back from the cosmos and the mystical stuff for a minute and get into the practical and the mainstream. Because while something like Elliott wave theory is pretty fringe, there are a couple of core tools that literally millions of traders use every single day.
First up, we have the moving average. The best way to think about this is as a noise-canceling headphone for a stock chart. A stock's price can be super volatile, jumping up and down every single day. The moving average smooths all that chaos out by showing you the average price over a set period, like 200 days. It gives you a much calmer, or as the source puts it, a more phlegmatic view of the real trend.
And look, it's actually really simple to calculate. On day 3, let's say the price is 10. The 3-day moving average is just the average of days 1, 2, and 3, which comes out to 9. Then, on day 4, boom, the price tanks to 5. All we do is drop the oldest price, which was 8, add the new one, and get our new average, which is 8. See how the average moves so much more smoothly than the day-to-day price?
So the rule of thumb for trading with this is super straightforward. A lot of traders will buy when a stock's price punches up above its moving average. They see that as a signal that this isn't just a random good day. It could be the real start of a new upward or bullish trend. And of course, the exact opposite is true for selling.
All right, the next couple of key tools are support and resistance, and these are all about psychology. Think of resistance as a price ceiling. It's created by all the people who bought at that high price before and are now just desperate to sell and get their money back. And support is like a price floor. It's formed by all the people kicking themselves for not buying at that low price before, who are now just waiting for a second chance to jump in.
Now, all of this sounds pretty plausible, right? It makes a certain kind of sense. But it all leads to the billion-dollar question. Does any of this stuff actually work? Or is the market just a random walk where the past has absolutely no influence on the future? Let's dig in.
Our source gives us this fantastic analogy to think about this debate. Is the market like a game of roulette, where every single spin of the wheel is completely independent of the last one? The wheel has no memory. Or is it more like a game of blackjack, where every card that gets dealt changes the odds of what's coming next? In blackjack, the deck has a memory.
So, which game is it? Is the stock market a game of pure chance where the past doesn't matter, making technical analysis totally useless, or does it remember where it's been, creating patterns and trends that a really sharp player might be able to take advantage of?
So what does the evidence say? Well, it's tantalizing. Academics who studied this for decades have found that the market is not a pure random walk. There's a slight positive correlation in the short term, meaning a good week tends to be followed by another good week. And interestingly, a slight negative correlation in the long term, meaning today's big winners are actually a little more likely to be tomorrow's losers. It's not a crystal ball for sure, but it's definitely not pure roulette either.
Okay, to wrap all of this up, I want to leave you with a concept that perfectly captures the strange, counterintuitive logic that might be hiding just beneath the surface of the market. It's a paradox about how you can actually win by combining two losing strategies.
I want you to imagine two separate games. Game S is simple. It's a bias coin flip. If you play it long enough, you are guaranteed to lose. Then there's Game C. It's more complicated, but the result is exactly the same. Play it long enough, and you lose. So you've got two completely separate, certified losing games. And here is where it gets absolutely nuts. If you don't just stick to one of those losing games, but instead you randomly switch back and forth between the two of them, you start to win. The combination of two losing strategies somehow creates a winning one. It makes no common sense, but mathematically, it's totally true.
And that leaves us with this one last, provocative thought. If something as bizarre as Paranda's paradox is mathematically possible, it just forces you to wonder,
What other non-obvious, counterintuitive truths might be driving the market, hiding right there in plain sight, just waiting for someone to find them?
Can you predict the stock market? I mean, really? It's the question, isn't it? The one that has kept investors up at night for, well, forever. We are absolutely desperate to find a story, a pattern, something in all that chaos. But what if that need to find order is actually our biggest weakness? This quote it gets right to the heart of it. You've seen technical analysis, right? All those charts with head and shoulders patterns and support and resistance lines. It's this whole industry built on the idea that you can predict the future by looking at the past. But this quote poses a devastating question. What if it's all random? If it is, then all those fancy tools are basically just a security blanket. So, okay, if it might all be comforting blather, why are we so drawn to it? Why do we spend so much time looking for these patterns? Well, that brings us right here, to the allure of the pattern. Turns out, we might just be hardwired this way, especially when our money is on the line. Oh man, this is so true, isn't it? It perfectly captures that emotional roller coaster we all ride. When our stocks are up, we're not just lucky. No, we're perspicacious geniuses. We saw the signs, we made the brilliant call. But when they go down, suddenly we're benighted idiots. We tell ourselves these little stories, taking all the credit for the wins and all the blame for the losses, and we completely ignore the massive elephant in the room. Pure, dumb luck. And you know what? That emotional high and low makes us, well, it makes us a target. It makes us incredibly vulnerable to the pundits and gurus who pop up on TV and tell these incredibly confident, engaging stories about why the market did what it did today. They sound like they know what they're talking about, but a lot of the time they're just narrating randomness after the fact. But what if there's another way to look at this whole thing? What if the stories are just, well, just stories? This is where we get into a really powerful and kind of controversial idea from modern finance, the theory of randomness. Okay, so here's this big idea. It's called the efficient market hypothesis, and it's actually pretty simple when you boil it down. Just think about it. You've got millions of incredibly smart, incredibly motivated people, analysts, fund managers, you name it, all staring at the exact same public information. Company earnings, news headlines, economic reports, the whole shebang. The second a new piece of info drops, they act on it, buying or selling instantly. So the theory goes, the price you see right now for any stock has already absorbed all of that known information. It's the best possible reflection of everything the world knows at this very second. Right, so if everything we already know is baked into the price, what's left to make it move? Only one thing: new information. A surprise product launch, a sudden political event, an unexpected report. And what's the one thing all new information has in common? By its very definition, it's a surprise. It's unforeseeable. It's random. So if the market is efficient, its movements have to follow what we call a random walk. There's actually a pretty great joke that sums this whole idea up perfectly. How many efficient market theorists does it take to change a light bulb? None. If the light bulb needed changing, the market would have already done it. It's funny because it gets at the core belief. There are no $100 bills just lying on the sidewalk. Any obvious opportunity is immediately snatched up and priced in. Okay, I know this idea of randomness can feel a little abstract. It's tough to wrap your head around. So let's bring it down to earth with something we all understand. A simple coin toss. Because this is where we see just how badly our own brains can fool us. All right, play along with me here for a second. Imagine a contest. 2 people, 1 coin. They flip it once a day for a whole year. One person gets a point for heads, the other gets a point for tails. Now my question is, over the course of that year, how often do you think the lead changes hands? So what do you think happens? Most of us, and I mean pretty much everyone, would guess the lead bounces back and forth all the time, right? It's a 50-50 coin, so it should stay pretty close to even. That's our gut feeling, that's our intuition. But the mathematical truth? It is shocking. It's actually way, way more likely that one person grabs the lead early on and just never lets go for almost the entire game. And I mean, it's really not what you'd expect. The numbers are just wild. If you run a similar contest for 1,000 flips, it is more likely that one person will be in the lead for more than 960 of those flips than for the lead to be split anywhere close to even. Think about that. Randomness doesn't look like a nice, neat seesaw. It looks like long, unbelievable streaks. So, a coin toss. What in the world does this have to do with Wall Street? Well, everything actually. We see a fund manager beat the market 5 years in a row, and we call them a genius. But are they? Or are they just on the head side of a very long, very lucky coin flipping streak? Statistically, if you have 1,000 analysts, pure chance says at least one of them is going to have a 10-year winning streak. We'll put that person on the cover of a magazine and invent stories about their brilliance, when really it could just be the law of large numbers at work.
Now that we know how our brains can get tricked by these streaks, let's look at how someone could use that against us. This is where we get into a classic con, the perfect prediction scam. This is so clever, it's scary. Here's how it works. A scammer starts with a huge mailing list, say 64,000 people. They send half of them a letter predicting the market will go up next week, and they send the other half a letter saying it'll go down. No matter what happens, they're right for 32,000 people. So they throw away the names of the people they were wrong for, and they do it again. The next week, they take the remaining 32,000, split them in half, and send out another up/down prediction. They just keep repeating this. After 6 weeks, they're left with 1,000 people who have seen them make 6 perfect predictions in a row. To those 1,000 people, this person looks like a prophet.
And the end game? What's the goal here? They send one last letter to those 1,000 true believers, and this time they say, for my next can't-miss prediction, send me $1,000. And a lot of them will. Just like that, the scammer makes a cool $1 million, not by knowing anything about the market, but by brilliantly exploiting our misunderstanding of probability.
Okay, so this all sounds pretty bleak, right? The market is random, our brains are wired to be fooled. Are we just supposed to give up on finding any patterns at all? Well, not so fast. Because for our final section, we're going to look at a fascinating twist. We're going to talk about seeing the hidden numbers.
Yeah, we've spent all this time talking about patterns that are just illusions, things that aren't really there. But what if I told you there's a real, mind-bendingly weird pattern hiding in plain sight in almost all the numbers around us? A pattern that's not an illusion at all. It's called Benford's law, and it's one of those things that once you see it, you can't unsee it. It says that if you take a big list of naturally occurring numbers, like, say, the populations of every city in a country, or the numbers in a company's accounting books, you'd think the first digit of those numbers would be pretty random, right? A 1, a 5, a 9, all should appear about equally. But they don't. Not even close. The number 1 appears as the first digit about 30% of the time. Why? Well, it's because things that grow exponentially, like populations or money, spend a lot more time in the hundreds on their way to 200 than they do in the 900s on their way to 1,000. Just look at this chart. It's not even close, is it? The bar for the number 1 is just towering over everything else. The number 2 is next, then 3, and so on. By the time you get down to the number 9, it shows up less than 5% of the time. This isn't an illusion. This is a real, predictable, mathematical pattern that shows up everywhere.
Okay, that's a neat party trick, but what's it good for? Well, it's actually an incredibly powerful lie detector. You see, when people make up numbers, say an accountant trying to cook the books, they try to make the numbers look random, so they sprinkle in lots of 5s, 6s, and 7s as the first digit. They don't follow Benford's law. So forensic accountants can run a company's financial statements through a computer, and if the first digits don't match this natural pattern, it is a massive red flag for fraud. So after all that, what's the big takeaway here? It's really a tale of two patterns, isn't it? The world is full of people trying to sell you certainty, trying to sell you patterns in the randomness of the stock market. And the lesson is you should be deeply, deeply skeptical of them. But that doesn't mean you should be cynical. Don't stop being curious. Because sometimes, like with Benford's law, the most amazing and truly useful patterns are hiding right there in plain sight. The real challenge is figuring out which patterns are real and which are just comforting blather.
Welcome to The Explainer. Today we're diving into the age-old battle between our heads and our hearts when it comes to investing. And we're doing it through the eyes of mathematician John Allen Paulos, who learned a very, very expensive lesson about what happens when a great story goes up against cold, hard numbers.
And this is it, right? This is the central conflict that every single one of us faces, probably without even realizing it. On one side, you've got the data, the spreadsheets, the ratios, the statistics. And on the other side, you've got the narrative, the vision, the hype, the dream of what a company could be. It's a powerful tug-of-war for your money.
So that's the million-dollar question, isn't it? This isn't just some theoretical problem. This is the actual personal story of how someone who literally lives and breathes mathematics got completely swept away by what turned out to be a corporate fairy tale.
All right, so here's our game plan. First, we're going to dig into the specific story that went so wrong. Then we'll hit the simple math that got ignored and the basic toolkit that could have sounded the alarm. From there, we'll uncover a really common trap involving averages, and finally, we'll see what happens when the numbers themselves turn out to be the biggest story of all.
Okay, let's get right into it. Let's talk about the story that captivated a brilliant mathematician and cost him a fortune. The company at the heart of this was a giant of the dot-com boom, WorldCom.
Now you gotta listen to the words Paulos uses here because it's so telling. He wasn't just invested. He says he was smitten. He was enchanted. He admits to rhapsodizing about their grand vision for the future of the internet. You see, this was a full-on emotional decision, driven by a fantastic story, not a rational one, based on the company's actual health.
And boom, here's the price tag for that enchantment. While he and so many others were captivated by the story, this one massive, fundamental number was just sitting there in plain sight: $30 billion in debt. This is exactly the kind of cold, hard statistic that a really good story could make you completely ignore.
So let's switch gears and talk about the bedrock of financial analysis that was totally overlooked here. I mean, before you can even think about analyzing a company, you have to get your head around the basic engine of all of finance: compound interest. People call this the eighth wonder of the world, and honestly, they're not wrong. It's this simple but incredibly powerful magic of earning returns on your returns. Your money goes to work for you, and then the money that money earned also starts working for you. It creates this incredible, accelerating, exponential growth curve.
And this idea leads right into its mirror image, a concept called present value. See, if compounding tells you how today's money grows into the future, present value does the exact opposite. It tells you what a future pile of cash is worth right now, today. It's the key to making rational decisions because it lets you compare money across time on an apples-to-apples basis.
Okay, so we've got the basic math down. Now let's see how that math gets turned into a practical, real-world toolkit for investors. These are kind of like the diagnostic tools a doctor would use, but they're designed to gauge a company's actual financial health, cutting right through any convincing story.
I absolutely love this analogy. Think of a stock's price like a person's weight. On its own, weight doesn't tell you much, right? Is 200 pounds healthy? Well, it depends if you're 5 feet tall or 7 feet tall. The P/E ratio is like a company's BMI. It puts the price into context by comparing it to the company's actual earnings, which gives you a way better picture of its health.
And the P/E ratio is really just the beginning. Serious analysts have a whole dashboard of these ratios. They look at price compared to a company's assets, its sales, its growth rate. You put them all together, and that's the core toolkit for anyone trying to invest based on fundamentals.
But here's where it gets really tricky. Even if you do all your homework and religiously focus on the numbers, you can still be misled. And that brings us to this mind-bending statistical illusion that separates the average result from what is actually the most likely result.
So let's do a little thought experiment. Imagine you've got this wild investment strategy. Every week, it's a coin flip. Heads, you make an 80% gain. Tails, you take a 60% loss. Now, the average weekly return is a positive 10%. So if you start with $10,000, what happens after a year?
Well, if you just calculate the outcome based on that average 10% gain each week, you'd end the year with over $1.4 million. This is what we call the arithmetic mean. And this is the number that gets blasted in headlines, right? It looks incredible.
But, and this is a huge but, the single most probable, most likely outcome for your 10 grand is that you lose almost everything. You'd end up with $1.95. That is the reality of the geometric mean, which accounts for the actual compounding of those huge gains and devastating losses over time.
So what on earth is going on here? Well, that big, sexy average is getting completely skewed by a tiny handful of incredibly lucky people who just happen to hit the 80% gain way more often than not. Their insane returns pull the entire average way up, while the vast majority of people experience something much closer to that total wipeout.
And this whole idea that extreme outcomes just don't last brings us to another really powerful concept in statistics: regression to the mean. It's just the natural tendency for any extreme result, whether it's unbelievably good or unbelievably bad, to be followed by a result that's, well, closer to average. It's just really hard to stay at the top.
And this perfectly explains something you've probably heard of, the Sports Illustrated cover jinx. See, an athlete doesn't suddenly get worse because they're on the cover. They get on the cover because they are performing at their absolute historical peak, a total outlier. Statistically, it's almost a guarantee that their very next performance will be closer to their normal average. It's not a curse, it's just math.
Okay, let's bring this all full circle. We've seen how a good story can make us totally ignore the numbers. We've seen how the numbers themselves can be misleading. But what happens when the numbers are an outright lie? Let's go back to WorldCom.
The final scale of the fraud was just, it's hard to even wrap your head around it. Over $9 billion in cookbooks. In a situation like this, even the most diligent investor using PE ratios and all those tools would have been completely lost, because the E for earnings was a complete work of fiction.
And the lie they told was brutally simple. They took billions of dollars in everyday running costs, just normal expenses, and they pretended those were long-term investments. This one simple accounting trick on the books made massive losses disappear and created gigantic fake profits, fooling pretty much the entire world for years.
You know, it's kind of ironic. The famous poet Goethe once called double-entry bookkeeping one of the most beautiful discoveries of the human spirit. And he's right. It's a system that's designed for perfect clarity, for elegance, for truth. It's supposed to be the ultimate triumph of statistics over messy stories.
And that leaves us right here with the final, crucial question. Relying only on stories is obviously dangerous, but relying only on statistics requires a deep, profound sense of skepticism. We have to analyze the numbers, for sure, but we also have to constantly question where those numbers came from, because sometimes the numbers themselves are just the most convincing story of all.
Have you ever just stopped and wondered how someone who is an absolute expert with numbers could make a catastrophic financial mistake? Today, we're going to dive right into a story about exactly that. It's about a mathematician who lost a fortune and what his story can teach all of us about the powerful and often ignored math of risk.
So, our story kicks off with a confession. And this isn't from just anyone. It's from someone you would expect to be totally immune to the kind of speculative fever that just ruins people. But as we're about to find out, nobody is immune.
Wow, that quote comes directly from our source, the mathematician John Allen Paulos. He's setting a really somber scene here. He's not just talking about losing some money. He's talking about becoming a ghost. I mean, what a haunting metaphor for complete financial ruin.
So who is this ghost? Well, it's our guide himself, an expert in probability and mathematics. He made one massive losing bet on a single and now infamous company, WorldCom. And this brings us right to the central puzzle of this whole story.
It's a fantastic question, isn't it? I mean, if a numbers guy can get it this spectacularly wrong, what hope is there for the rest of us? Well, the answer lies in the tools he was using, the psychology behind a long-shot bet, and a really fundamental misunderstanding of what risk truly is.
All right, so to really understand his mistake, we first have to get a handle on the financial tools that seemed so promising to him. We're talking about stock options. Now, they sound complex, but the basic idea is actually surprisingly simple.
You know, what's really fascinating here is that options kind of have a split personality. On one hand, they can be a super smart way to protect your investments, almost like an insurance policy. But on the other hand, they have the seductive thrill of a lottery ticket. You know, a small bet that could potentially lead to an astronomical payoff.
Okay, so first up is what's called a call option. I want you to think of this one as the lottery ticket. You're buying the right, but not the obligation to purchase a stock at a locked-in price in the future. You do this when you're just absolutely convinced a stock is about to go to the moon.
And on the flip side, you've got the put option. This is your insurance policy. Buying a put gives you the right to sell a stock at a guaranteed price. It's your safety net, just in case the stock you own suddenly takes a nosedive.
So to put it really simply, calls are for optimists and puts are for pessimists, or, just prudent investors. With a call, your potential profit is technically unlimited. And for both, the absolute most you can lose is the money you paid for the option itself. And you can see how that limited risk is a huge part of what makes them so appealing.
And right here, our author connects all these abstract ideas back to his personal disaster. See, he wasn't buying puts to insure his portfolio. No, he bought a boatload of call options on WorldCom, betting everything on a massive comeback that, well, it never came. He was playing the lottery, not buying insurance.
But just buying lottery ticket options wasn't his only mistake. Oh no. He then amplified his error with one of the most dangerous tools in all of finance: leverage.
Buying on margin is basically like pouring gasoline on a fire. You're borrowing money from your broker to buy even more stock. If the stock goes up, you make an absolute fortune. But if it goes down, your losses are magnified, and now you owe your broker money you might not even have.
And this is the death spiral it creates. The stock price falls. That triggers a margin call from your broker, and they're demanding more cash now. And you're suddenly faced with this brutal choice. Do you sell and lock in your losses for good? Or do you throw even more good money after bad just to stay in the game?
This little anecdote, man, it is just devastatingly human. The pressure, the secrecy, he gets that margin call, and while his wife is just browsing in a bookstore, he sneaks away to deposit a check. He even admitted his illicit affair with WorldCom was still going. You see, this wasn't a rational, calculated decision anymore. It was purely emotional.
So with his emotions clearly running the show, were there any mathematical tools that could have saved him from himself? The answer is yes, absolutely. And the first one is a concept called expected value. Expected value is it's this beautifully rational way to look at any uncertain choice. Now, it doesn't tell you what will happen next time. What it does tell you is the average outcome if you could make that same decision 1,000 times over. It basically strips all the emotion out of the equation.
Now, to make this really concrete, our source uses a brilliant, everyday example, just deciding where to park your car. You can pay for a spot in a lot, or you can take a chance and park illegally on the street. Each choice has different potential costs and different probabilities. So, which one is the better financial decision?
So, when you actually do the math, the expected cost of parking in that safe lot is $13. But for parking on the street, well, the expected or average cost is only $11. Now, the crucial point here is that over the long run, parking on the street is actually cheaper.
But hold on a second. Just because it's cheaper on average doesn't automatically mean it's the right choice for you right now. I mean, what if you're the one who gets that $100 ticket? Expected value tells us the average, but it tells us absolutely nothing about the wild swings between outcomes. And that, my friends, is the very definition of risk.
And this brings us to the final crucial piece of this whole puzzle. It turns out there is a way to mathematically measure risk, to actually put a number on that gut feeling of uncertainty.
And that measure is called standard deviation, or in the world of finance, they call it volatility. You can think of it as a number that just describes how spread out all the possible results are. A low number? That's predictable. A high number? Well, that means you are on a serious roller coaster. And just look at the difference here. The risk of the parking lot is tiny, a standard deviation of just 1.73. But the risk of parking on the street? It's massive, over 23. It is more than 13 times as volatile. Sure, it might be cheaper on average, but it is a far, far riskier bet.
So here's the big takeaway from all of this. Our mathematician, he was seduced by the small possibility of a huge win, that classic lottery ticket psychology. He focused on the one potential outcome he wanted to happen while totally ignoring the math. He ignored that massive standard deviation, the huge volatility, that was just screaming that this was an incredibly risky bet with an extremely high probability of ending in total ruin. You know, in the end, this entire story shows us that we have all these sophisticated formulas, like expected value and standard deviation, to measure external risk, but the hardest risk to quantify, the one that turned a brilliant mathematician into a ghost, is the one that comes from within us. How do you possibly put a number on hope, on fear, or on that stubborn refusal to just admit we made a mistake?
All right, today we're going to tackle one of the most important ideas in all of smart investing, diversification. Now, I know it sounds like a fancy, complicated word, but the logic behind it is, believe it or not, super simple, and we're about to break it all down. So let's kick things off with a story. And I'll warn you, it's a bit of a painful one. Because, you know, sometimes the best way to really get why a strategy is so important is to see the absolute train wreck that can happen when you ignore it. Oof, this line right here just says it all, doesn't it? It comes from our source material, where the author talks about his own brutal experience investing in WorldCom stock. It just perfectly captures that sickening, gut-wrenching feeling of watching all your hard work, all of your savings just evaporate.
It's a fear that honestly keeps a lot of good people on the sidelines. So that really is the big question, isn't it? How do you get in the game? How do you tap into the incredible growth potential of the market without risking your entire nest egg on one roll of the dice? Well, there is an answer, and it all starts by kind of rethinking what risk even means in the first place. You know, if you ask most people this, they have an immediate gut reaction. We've all heard it a million times. Oh, stocks are risky. It's almost baked into our culture. But to build a really smart strategy, we need to dig a little deeper. We need to figure out what that risk actually is, and if it's even the whole story. Okay, let's break down the real difference here because it's huge. When you buy a stock, you're becoming a part owner. You own a tiny slice of the company. Your fortunes rise and fall right along with it. But with a bond, you're not an owner. You're a lender. You're loaning the company money, and they promise to pay you back with interest. It's a much safer spot to be in, but as you can see, usually not as rewarding. And this chart, man, it just perfectly shows why people are willing to take that ownership risk with stocks. I mean, look at this. Over almost 200 years of data, stocks have, on average, delivered nearly double the return of super safe government bonds. That gap, that difference, when it compounds over your lifetime, it is absolutely massive. So, if the long-term returns are so fantastic, where does this whole stocks are risky reputation come from? Well, the answer isn't about the destination, it's about the journey. It's all about the crazy, bumpy ride you have to take to get there. This number right here, this is the culprit. The nerds call it standard deviation, but let's just call it the wobble factor. It means that in any given year, the real return on stocks can swing wildly above or below that long-term average. It's that wobble, that up and down unpredictability that feels so darn risky to us. And this, my friends, is the million-dollar question. How do we get that sweet, sweet upside of stocks while smoothing out that stomach-churning white-knuckle ride? Believe it or not, the answer is hidden in a simple story about two families who just couldn't stand each other. So let's jump into this really cool analogy that makes this whole idea click. It's all about two businesses whose success is completely at the mercy of the weather. Okay, so imagine you've got two investment choices. First, you've got Hatfield Enterprises. They sell snow shovels, so when it's a super snowy winter, they are absolutely killing it. Then you've got McCoy Productions. They sell tanning lotion, so they clean up when it's a long, hot summer. On their own, their success is a total coin toss based on the weather. Now watch what happens. If you put all your money in Hatfields, you're a genius in a snowy year up 40%, but you get crushed in a sunny year. The exact opposite is true for the McCoys. But what if you don't choose? What if you just split your money right down the middle, 50-50? Well, in a snowy year, Hatfield's huge gain more than covers McCoy's loss, and you make 10%. And in a sunny year, McCoy's big win cancels out Hatfield's loss, and you still make 10%. Suddenly, your return is totally stable no matter what the weather does. So think back to that wobble factor we talked about, that standard deviation. On their own, both of these stocks are bouncing all over the place, from huge gains to huge losses. They're super volatile. But what happens to the wobble when we put them together in one portfolio? And the answer is zero. Nothing. Nada. It's gone. The volatility completely vanishes. By owning two things that move in perfectly opposite directions, you've basically engineered a portfolio that gives you a steady, positive return with zero risk. And that is the magic of diversification. Now, this magic actually has a technical name. It's called negative covariance. It's just a fancy way of saying that when the Hatfield snow shovel business zigs, the McCoy tanning lotion business zags. And finding assets that zig and zag at different times is really the secret sauce of building a strong, modern portfolio. Okay, of course, in the real world, finding perfect opposites like snow shovels and tanning lotion is, well, it's pretty much impossible. So professionals use a much more practical tool. It measures how any stock tends to move, not against one other stock, but against the entire market as a whole. And that tool is called beta. All beta tells you is how jumpy a stock is compared to the overall market. Think of the market as having a beta of 1. If a stock has a beta higher than 1, it's more volatile than the market. If the market sneezes, that stock gets pneumonia. If its beta is less than 1, it's calmer and less volatile. Our source material has this brilliant way of thinking about it. Beta is like a stock's emotional reactivity. A high beta tech stock might be like a total drama queen, overreacting to every little piece of news, magnifying all the ups and downs. But a low beta utility stock is more like the calm, stoic friend. It just kind of mutes those market swings.
The goal is to build a team of stocks with different personalities, so your overall portfolio has the emotional reactivity you're comfortable with. Okay, we have covered a ton of ground here, right? We've gone from scrambled eggs to feuding families to Greek letters. So let's bring it all home. What is the one big, smart takeaway you need to remember from all this? This right here is so important to understand. There are really only two kinds of risk. The first is company-specific risk, the risk that your one company, your WorldCom, goes belly up. Here's the good news. You can almost completely get rid of this risk just by owning lots of different stocks. But then there's market risk, the risk that the whole economy takes a hit and everything goes down. You can't diversify that away. No one can. So here's the bottom line. The whole point of diversification isn't to get rid of risk completely. It's to get rid of the stupid risk. The risk you take that you don't get paid for, like betting your entire future on a single company. When you get rid of that, all you're left with is the risk of the market itself, which, as we've seen, has a long history of rewarding patient investors. And that kind of leaves us to one last idea to chew on, this whole principle of not putting all your eggs in one basket. It's an incredibly powerful tool for building wealth, but it's also a pretty powerful tool for building a life. I mean, think about it. How can you diversify your skills, your friendships, your experiences to build a life that's resilient and rewarding and, well, rich in every sense of the word? Something to think about. Thanks for joining me.
Have you ever been there? You're watching the stock market just tank, and you're frantically scrolling through the news, looking for the reason why. Only you find absolutely nothing. Right? No big announcement, no global disaster, no economic bombshell. It feels like a phantom crash, like a ghost in the machine. So where in the world does all that volatility come from? Well, let's dig in.
So, this is the big mystery we're going to try and solve today. Why do markets, which are supposed to be these rational, calculating machines, sometimes just freak out for no apparent reason? The answer, and this is what's so fascinating, isn't always about what's happening out there in the world. A lot of the time, it's about what's happening between the investors themselves.
You know, this feeling of dread is something anybody with skin in the game knows all too well. The author of our source material, he felt this in his gut, watching his own WorldCom stock. It's that knot in your stomach when you're waiting for the opening bell. That feeling comes from knowing deep down that the market kind of has a mind of its own. So let's try to figure out what that mind is actually thinking.
Okay, so to get our heads around a massive market crash, we actually need to zoom all the way in. I mean, forget about the millions of traders for a second. The whole dynamic can start with just two people and a secret that isn't, really a secret. And this is where it starts to get really interesting.
This brings us to a really crucial idea called common knowledge. Now, this is different from just, say, two people knowing the same secret. Common knowledge is when I know something, and I know that you know it, and I also know that you know that I know it. You see where this is going? It's an infinite loop of awareness, and that shared awareness is the tiny gear that's going to turn this whole machine.
So let's meet our two investors. We'll call them Alice and Bob. They both have a tiny piece of insider information about a company, but neither one has the whole story. Alice, she knows which project the company chose. Was it the handheld device or the new phone? Bob, on the other hand, he only knows one thing, whether that phone project specifically failed. Each of them has a critical but totally incomplete clue. So here's how it all goes down. At first, Alice and Bob act on their own private information, and it actually leads them to make opposite trades. But here's the kicker. Those trades are public. Alice sees Bob buy, and she thinks, what does he know that I don't? And Bob sees Alice sell, and he gets a clue about what she knows. And as these little clues get out there, their separate private information starts to morph into common knowledge. And once they both have the same, more complete picture, well, their views align, and bam, they both sell, creating a little mini crash.
And that is the whole point, right there. The stock crashed. But did any new information come out from the company? Nope. Nothing external happened at all. The entire crash was caused by an internal shift. It was caused by information that was already floating around, finally becoming common knowledge. It was basically a communication crash. All right, so that's the logic on a tiny two-person scale. Now let's zoom out and see how this whole thing scales up from Alice and Bob to the entire herd. Because, while those two explain the mechanism, the market's real, raw energy, that comes from the crowd. Now, in this herd, you've basically got two main types of animals. You have your value traders. Think of them as the anchors. They look at the fundamentals, they buy what they think is cheap, and they sell what's expensive. They're a stabilizing force. But then you have the technical traders. These guys are the accelerators. They just ride the wave, buying what's already going up and selling what's going down. And it's this constant push and pull between these two groups that creates the market's rhythm and, of course, its wildness.
Okay, this is one of my favorite analogies ever. Scientists set up an experiment for an ant colony with two totally identical, constantly refilling piles of food. Now you'd think the ants would just split up 50-50, right? Makes sense. But that is not what happens. The number of ants at each pile just fluctuates like crazy. It never settles down. Why? Because each ant's decision is just slightly influenced by the other ants it bumps into. And if you graph those fluctuations over time, it looks almost exactly like a stock chart. It's wild.
And that's the big idea here. Whether it's ants choosing food or a super simple computer program coloring in bricks based on the ones above it, you see the exact same thing. You do not need complicated external news to get complicated, random-looking behavior. So the point is, a whole lot of the market's day-to-day noise is just generated internally. It's just traders reacting to other traders.
So, now that we've seen how these simple little interactions can create all this complexity, let's zoom out one more time to the entire system. And here, we're leaving the world of simple rules behind and entering the pretty mind-bending world of chaos theory. This is what really helps explain why the market is, at its very core, just fundamentally unpredictable.
The market is what scientists call a nonlinear system. Okay, so in a simple linear system, if you push something twice as hard, it goes twice as far. It's simple, it's predictable. But in a nonlinear system, a tiny little push could do nothing at all, or it could trigger an absolute avalanche. The outputs are just wildly out of proportion to the inputs.
To get your head around this, imagine a pool table that's just covered in random round obstacles. A pro player takes a shot. Now you ask them to replicate that shot perfectly. It's impossible, right? Even a microscopic difference in that initial angle, we're talking the width of a single atom, is going to get magnified with every single bounce off an obstacle, sending that ball on a completely different journey. This is a classic idea called sensitive dependence on initial conditions.
And of course, you know this concept by its much more famous name, the butterfly effect. It's this idea that a tiny, seemingly insignificant little event in a complex, nonlinear system can cascade and blow up into a massive, totally unpredictable outcome somewhere else down the line.
And this right here is the stock market. A company missing its earnings forecast by a single penny shouldn't, logically, wipe out billions of dollars in value. But in a chaotic, nonlinear system like this, that tiny little input can absolutely trigger a catastrophic chain reaction. And this is why trying to predict the market is so often a fool's errand. The starting conditions are just way too complex to ever measure perfectly.
So, the market is chaotic. Got it. But chaos is not the same thing as just pure randomness. There's actually a hidden structure underneath it all, a structure that's defined by connections. And this is the final piece of our puzzle, learning to see the market not just as a crowd, but as a network.
You know, a lot of networks in our world, from the internet to our own social groups, they're not built equally. They follow something called a power law. What this means is, instead of everyone having kind of the same number of friends or connections, a tiny few have a massive, way out of proportion number of connections. Just think about a few super influencers on social media compared to, well, everybody else. This chart right here shows you the crucial difference. Most things in life follow that familiar bell curve on the left, where extreme events are incredibly rare. But networks like the market, they follow a power law, which creates what they call fat tails on the graph. And those fat tails mean that extreme events, like huge market crashes, are way more common than a normal model would ever lead you to believe. The market doesn't live on a bell curve. It lives in the wild world of fat tails.
And I promise you, once you start looking for these power laws, you see them absolutely everywhere. The most common word in English, the, is used way more than the 10th or 100th most common word. The biggest city is vastly larger than most other cities. A few websites get almost all of the links online. It's just a fundamental organizing principle of complex, connected systems.
And get this for a mind-blowing consequence of this structure. Because the World Wide Web is a power law network with these hyper-connected hub sites, the average distance between any two random pages on the entire billion-page internet is just 19 clicks. The world is so much smaller than we think, all because of these superconnectors. So, this brings us to the final answer to our mystery. Most of the time, the market just zigs and zags kind of randomly. But because it's a power law network, there are a few hyper-influential nodes out there. A major analyst, a huge mutual fund, a big story on a news outlet. And when these super connectors just happen to align and all point in the same direction, they can literally pull the entire network with them. And that is what triggers the kind of extreme, fat-tail events we call a crash. It's not a bug in the system, it's a natural feature of the network structure.
And that really leaves us with a final, much bigger thought. We've just seen how these dynamics of connection and influence create these wildly disproportionate outcomes in the stock market. So, if these exact same power law and network effects are at play in our society, what does that say about the extreme disparities we see in wealth, in media attention, and in political power? The very same forces that can crash a stock might just be shaping our entire world.
All right, let's dive into something weird, a real head-scratcher from the world of finance. We're going to talk about a theory about the stock market that has this bizarre twist. It only works if most people believe it's completely wrong. You've probably heard this famous line from Groucho Marx, right? I'd never join a club that would be willing to accept me as a member. Just think about that for a second. It's a perfect little paradox. The very thing that would let him in is the exact reason he'd say, no thanks. The statement kind of eats its own tail.
Okay, so keep that Groucho Marx idea in your head. Because what if the stock market works the exact same way? What if it's built on that same kind of self-defeating logic?
And that brings us right into our first big idea, the efficiency paradox. Yeah, we're going to look at a theory that's a lot like Groucho's club. It has a funny way of tripping over its own feet. So this theory has a name, the efficient market hypothesis, or EMH for short. The core idea is actually pretty straightforward. It says that a stock's price already reflects everything we know about it. All the news, all the reports, all the data, it's already baked in. So what makes a stock price move? Only new stuff, surprises. And since you can't predict surprises, well, you can't predict stock prices. Okay, but here's where it gets really weird. This is the paradox. Let's say everyone believes the EMH is true. They'd think, hey, the market's efficient, so what's the point of doing all this research? They'd all just buy index funds and call it a day, right? But wait, if nobody is digging into the numbers and analyzing companies, then who's making sure new information gets into the price? Nobody. The market would get slow, lazy, and you guessed it, inefficient. Now let's flip it completely. What if most investors think the EMH is total nonsense? They'd all be out there, hunting for an edge, digging through financial statements, trying to find that one piece of information nobody else has. And what's the result of all that frantic, competitive research? Well, new information gets discovered and priced in almost instantly, which ironically makes the market, well, efficient. So you end up with this absolutely mind-bending conclusion. The efficient market hypothesis is true if and only if most people believe it's false. It's their disbelief, their constant searching for an edge, that actually powers the whole system and makes it work. It's like this perfectly balanced paradox. Which brings up a big question. How does this actually work in practice? That's what we're tackling next in what you could call the investor's arms race. We're going to look at the engine behind this paradox and see why it's so darn hard to keep any kind of advantage in the market for long. So, let's say you do it. You find the secret sauce, a simple, foolproof rule for making money in the market. You'd be thrilled, right? But what happens when other people start to notice you're winning? They're going to try to figure out what you're doing. And the moment they do, the race is on. A great way to understand this is the classic prisoner's dilemma. You know the setup. Two partners in crime get caught, and the cops separate them. If they both keep quiet, they get a small sentence. That's the best outcome for the team. But for each individual prisoner, the safest bet is always to confess and rat out their partner. So because they're both acting rationally in their own self-interest, they both end up confessing, and they both get a worse sentence than if they just worked together. Now, let's take that exact same logic and apply it to investing. An investor finds a little market inefficiency, a profitable anomaly. What's the rational thing to do? Exploit it immediately. But just like with the prisoners, when every investor thinks that way and jumps on the same opportunity, they all pile in. And pretty soon, that juicy advantage gets competed away until it completely disappears for everybody. And that right there, that's the engine of market efficiency. It's this constant, never-ending arms race. Everyone is looking for an edge, and that very search is what cancels all the edges out. Every brilliant new strategy gets found, copied, and basically neutralized, which just keeps pushing the market back to being efficient. Okay, so we've established this arms race makes the market efficient. But what does an efficient market actually look like? How does it behave? To get a handle on that, we're going to borrow an idea from computer science, the language of complexity. All right, let's try a little thought experiment. Imagine every price tick in the market, up or down, is just a 1 or a 0. So look at this first sequence. It's just 0, 1, 0, 1. Super simple, right? You know exactly what's coming next. It's perfectly predictable. Okay, now what about the second one? You can kind of see a pattern. There's some regularity there, but it's definitely more complex. A lot harder to guess the next number. And then there's sequence 3. To you and me, that just looks like random noise. There's no obvious pattern at all. It feels totally unpredictable. This idea actually has a formal name, algorithmic complexity. A simple way to think about it is this. What's the shortest possible recipe or computer program you could write to generate a sequence? For that first simple pattern, the recipe is tiny, right? It's just repeat 0, 1. But for that third random-looking sequence, there's no shortcut. The shortest recipe is just writing out the entire sequence itself. So if we put that on a chart, it's pretty clear. Sequence 1, with that easy pattern, has super low complexity. Sequence 2 is somewhere in the middle, and sequence 3, the one that looks totally random, that has the highest complexity because there's no simple recipe for it. And this is the big punchline. A truly efficient market looks just like that third sequence. It looks random. Its pattern is so incredibly complex because it's the result of millions of smart people all trying to outsmart each other and canceling themselves out. The system is so sophisticated that to any one of us, it just seems like unpredictable noise. But here's the thing. Markets aren't just math problems or strings of ones and zeros. They're made of people. And that brings us to our final and maybe most important piece of the puzzle, the human factor. This is where the clean, elegant theory crashes into messy, unpredictable human psychology. And to really bring this home, let's get personal. The author of the work we're drawing from shares his own story of investing in a company you might remember, WorldCom. And this quote, wow, it just perfectly captures that horrible, sinking feeling when a sure thing turns out to be anything but. It was a no-brainer, all right, but not in the way he thought. So what happened? Why did it go so terribly wrong? Well, he basically broke every fundamental rule in the book. He got sucked into the hype, put way too many eggs in one basket, didn't have any insurance for a downturn, and even bought on margin with borrowed money. These are the classic mistakes we all make when emotion takes the wheel from logic. And this whole story just highlights a fundamental truth about Wall Street. You have this constant tug of war between the numbers and the narratives, between cold, hard logic and human emotion. The market can look like a perfect, rational machine until it doesn't. Until what some call animal spirits, fear, greed, pure hype, come rushing in and just take over everything. So we're left with this one last thought, and it comes from an old story about trying to weigh a cow. The method involved balancing the cow on a plank with a giant boulder, and then doing some math. But after all that, there was still one problem. You had to guess the weight of the boulder. Which makes you wonder, how can we ever hope to accurately weigh the market? How can we get a true reading of its value when our own collective guesses, our hopes, our fears, aren't just part of the calculation? They are the thing we're trying to weigh.